Well, hello everybody. Yakidachi here. Yakidachi in his house. Uh, just trying a slightly different topic today, and I hope the YouTube algorithm doesn't punish me too hard for switching tracks a little bit. But um, I uh, I like to focus on going to special events and walkthroughs. And thank you for the immediate response. I posted just I don't know 15 minutes before this broadcast. Uh, Two videos from. Uh, Sakura cherry blossom watching in downtown Left Coast City here in Canada, and and also a DJ public disco event happening in the same location or beside their neighbors practically, celebrating cherry blossoms with a bit of EDM, oonch, 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 oonch. And they've already clocked in at, dare I say, 300 views each in a matter of 10 minutes. Stunning. Thank you so much for the support, guys. I appreciate every one of you viewers. Even if you just want to take 30 seconds out of your day and watch something fun and relatable. I mean, that's my credo, fun and relatable. Um, Although this topic may not be as fun. There's some solace. There's some solace. Today we'll be talking about how to survive financial turmoil and learn from the successes and, more importantly, the mistakes that I did as a sort of investor. I'm much better at it now, especially since the events of the last 6 months, including this week, believe it or not. Um, Not because I'm doing anything crazy or I'm pulling out charts or spreadsheets. It's more of a philosophy and it may not work for everybody. So remember, this is not investment advice. Please consult a financial professional. I'm certainly not one. If you get financial advice from a cartoon on the internet, you should actually seek more than just financial help, I would say. Yeah. Cringe. Um, yeah, so I just want to basically I'm just going through my lived experience with dealing with money and markets and what started to work for me finally, even in the turmoil of just this week. Um, because we all have to go through the misery of the markets. We have the success and the misery, right? Also, by the way, my walkthrough of the UBC Anime Club's Hanami pop up. One of the videos is already at 785. I'd certainly love to see 1,000 views on that one. If we get 1K, that would make my day. 1K makes my day. And of course, like and subscribe, because if you subscribe, then you won't miss all this fun content and maybe getting to places that you would like to go, but you never had the chance to, or whatever. Um, Ride along with me. Ride along with Yakidachi. All right. Anyway, my investment journey. Well, considering I'm in my middle age now, I'm not quite a senior, but I'm certainly technically I'm not even a boomer. I'm just a really old Gen Xer. But you know, to all you you know Gen Alphas out there, I might as well be ancient news anyway. I'm like 3 days older than dirt. So what does it matter? Um, but I've lived and experienced through several uh, markets ups and downs, and I mostly experienced the downs. I'll tell you why in a bit. But yeah, just gonna talk about my lived experience with markets, what I surmise is going on, what are the things that you may want to look further on your own time and with your own sources, right? Don't just take it all from me. Take it from triangulate your sources from various different buckets of info, right? Um, I I I look at you know uh, market data. I also look at analysis from a left-wing perspective and also a right-wing perspective, because especially the ones who are very uh, critical even on their own side is valuable, because they'll point out flaws that you may not even heard of. You already know what the flaws are going to be put forward by various um, factions of the political left and the political right. But when they critique their own side, which does happen, it's usually critique that you may not have heard of, because it's not broadcast back and forth like the typical partisan uh, barbs are thrown at each other. Anyway, so as a almost boomer, I came of age during the 1990s. So I graduated in high school in the 80s, which meant that my pop idol in the 80s was Madonna. Yikes! That doesn't make you feel old. And then yeah, went from Madge and had a couple of failed starts in college. I wasn't doing very well in college. I think by 1990, I was already on my third college. I was a dropout through two of them, uh, three of them, sorry, but two of those times were because of health reasons. And I realized pretty quickly that I probably wouldn't be able to make it as a freelance cartoonist. I just wanted to be a cartoonist, man. But then I started getting chronic health issues, and I started to think, well, I need a steady paycheck. I need a company health benefits. Maybe it's time I should actually get as they say these back in the day, a real job. Get a real job. Oh boy. All right. So after a couple of failed attempts at being an artist and studying fine arts, I decided to become a sellout. I became a sellout and became a commercial artist. Oh, that means I was going to design uh, laundry soap packages or something. Maybe I'll design a logo for a stick of deodorant. My fine art dreams up in smoke. But I had a serious chronic disease, so I had to do something about it. Couldn't do it with just my fine art alone. So sold out, studied graphic arts in my dusty old hometown, where they only like two types of music, country or western. Take your pick. I was more of a western guy myself. But at any rate, I just had to move on out of there and go to the big city and study some commercial art. And certainly glad I did, because I landed a job in the left coast city of Canada. And wow, in the mid 90s, things were starting to hop. I jumped on the digital art bandwagon, so I was not doing traditional print media or uh, video media. I went straight into multimedia, graphic design, and digital art and design. And so that afforded me a chance to jump on the .com bandwagon. Yeah. So I worked for a company making graphics for about 3 or 4 years, and their work started to dry up, and so I was summarily laid off, and then immediately was hired by a software company to design their graphics for their web pages and their partners. And I even helped them to get web addresses, because web addresses were like the Wild West back then. All the best ones were taken, right? Pets.com, already taken. You had to make up a name like Cisco or Microsoft back then in order to get a domain registry for .com, that coveted .com address. So we actually would spend weeks trying to find even just an address name and register it on Internet, if anyone remembers it, that domain registry, and that sort of thing. So not only was I web designer, I was trying to pitch address ideas and say, well, you can always buy it. If you don't like it, you can just, you only bought it for a year. It's a placeholder until you come up with a better name. And frankly, 8 times out of 10, they couldn't think of a better name because all the other ones we taken already. So they were stuck with it, whether they like it or not. And I got the credit. Anyway, so got on the .com ride, was riding around. We got some stock options. I was able to sell some of the options before 2000. And what I'm going to show you is what 2000 looked like. And oh yeah, I forgot to mention I had a live-in girlfriend at the time. I know, me not single, weird. And I was supporting her because she was a full-time student, and supporting her in her in the household, and main breadwinner. And then this happened. Here we go.
Described as nothing short of breathtaking, a points drop never before seen on the US markets.
What?
This
What
closing
happened?
bell might as well have been an alarm, so savage was the selling.
Yeah. So what happened? What happened was that the .com became the .bomb. It was a .bomb era. So all those high flying .com stocks, they're high flying even without any proven revenue model. Sometimes they would just advertise how many clicks they got on their web page. Can you believe that? So it wasn't even any proven revenue models. Like, oh no, we have a lot of traffic on our web page. So we'll somehow make money somewhere in a distant future. And that's what people bought into, but they bought into it so hard that companies that should had no business of running were running until they ran aground, and their business model turned out to be just a bunch of smoke and mirrors, and they crashed. And by crashing, you can tell it's the proverbial throwing the baby out of the bathwater. So even high flying stocks from Amazon and Microsoft and Apple and all these other ones just got decimated in 2000. And yeah, I'll let the commentator speak on it. So this is the New York Stock Exchange on the floor. Back when things weren't so computerized, you'll see a lot of traders down on the floor. I kind of miss that vibe, to be honest. But yeah, let's keep going here.
In percentage terms, it had less impact than the crash of '87, but it still left traders and investors shell-shocked.
You saw it, didn't you? It was down some.
Why? How come?
I don't know. Bad day.
Bad day for you?
Another one, yeah.
I know.
Too many in a row.
Too many in a row.
Sparked by a jump in US inflation. The fear a bigger hike in interest rates the only remedy.
Yeah. So inflation fears. Where have we heard this before? Let me rack your brains. Oh, geez, must be a distant memory now. When was the last time we had an inflation scare? Oh yeah. Oh, right. Like, yeah, about 17 days ago. Ha ha. So we've had so the ghosts of inflation have come back, which challenges markets because that means it erodes corporate profits. It not only erodes your paycheck, it erodes the profits of companies. And if your company is already shaky with profits in the first place, or doesn't have a proven revenue model anyway, like a pets.com, for example, so a .com company with no proven revenue, all of a sudden you get discounted to infinity. In other words, no one's going to buy your stock because now they're going to be afraid that they're never going to make any money because inflation is just going to eat into whatever meager revenue you're going to pump out, even if you're at a loss. So it just be like basically throwing more weight onto a sinking boat. It'll just sink faster, right? Give me a second while I drink my drink of choice tonight is, by the way, ginger ale. Not gonna say it's a brand name though, but let's say it's based on a British brand. Although I do much prefer the Canadian version of ginger ale, but not available at my conveni near me today. So otherwise, I'd be like, "Go Canada!" Oh, anyway, so let's go see what the further as they say on this news piece. Here we go.
It was enough to force the Dow Jones down 616 points, a drop of 5.5%. The fragile technology stocks even harder hit. The Nasdaq index in freefall, down nearly 10%.
So in traditional stock market jargon, 10% is a correction. Because that implies that the investors got a little too overhyped, but not severely overhyped. They just got a little ahead of themselves, and we're just gonna pull back a little bit, just a little bit to sort of to right size the price of the shares to a more appropriate level. And we know what happened after this. This is just a one-day news report, but the Nasdaq fell to the point that it took a decade, 10 years, to go back to this level again. So what happened in 2000? The price of it didn't return to its nominal value. Nominal means not accounting for inflation. So let's just say the Nasdaq was 33.22. It dropped so much that it took 10 years to go back to 33.22. That's the definition of dead money. That's like you might as well take $3,322 and stuff it under your mattress for 10 years and say, wow, I tied the Nasdaq. Yikes. So yeah, that's the very definition of dead money. But in the meantime, it's not only at 9.6, it'll be 6 feet underground. It'll be more than that drop, right? And could you imagine what happened at my workplace when this was happening? And in my software company, this .com, what the engineers were thinking, what the marketers were thinking, what this former cartoonist, fine artist was thinking. Me, what was I thinking? Oh crap. Oh well.
It lost a quarter of its value in just 1 week.
Once this body started in motion, it was very, very difficult to put the brakes on. And by 1 o'clock, everyone threw in the towel and said it's a foregone conclusion. These things are going down. We'll wait till Monday to get back in the game.
But that game could be a rough one when our markets open on Monday morning. The expectation is that Australian stocks will be hit too.
The few days that we have in the market next week will certainly be volatile.
The only saviour, Aussie stocks are not as overvalued as those in the US and
yeah, so again, you're seeing there's a global side effect on this. There's already a global side effect with the current market turmoil hitting all shores. So there's seemingly no place to hide. Where's the safe areas? Where's the safe assets? There's nowhere to hide, or is there? Well, I'll talk about my experience later on. I'm still just a young 20-year-old guy who's a novice in all this, and emotions just coursing through me. My livelihood's at stake. I have a girlfriend who's in university that I'm also trying to support, and all this other responsibilities on my head. I even remember I had an inkling that things are going to be stinky. I'll tell you about my inkling. Okay, I'll tell you about my inkling. I'll tell you 2 things that I did. Because I could see the gears grinding more. You can hear the grinding noises in the back office where I was working in the software company in terms of custom orders and stuff. You'd hear some scuttlebutt like the canceled orders and all this other canceled contracts and all this other stuff, and you're going, oh, this is not good. So even if we were in a secular bull market, maybe the rest of the market was doing fine. Maybe as our company, we weren't doing so good because there's always winners and losers even within a industry sector, right? So I thought, oh no, maybe we're a loser. Maybe I gotta find an exit strategy. So the first thing I did was increase the percentage on my credit card. No, I was supposed to lower it, right? No, I increased it because that bought me insurance for balance protection. In other words, if I got laid off longer than 90 days or something, then they would have to pay my balance. So I just said, yeah, increase my interest rate on my credit card by 1.5, please, because just cause. Because I realized, oh my God, things could get shaky just from my company. I wasn't thinking about the stock market. And then this happens. The other thing that told me that things were getting really, really out of hand was when AOL, America Online, you've got mail. Um, anyone remember American Online? Remember the endless CDs of AOL that would come drop into your mailbox and stuff? Oh my God. Or inserted in magazines. It was just crazy. AOL everywhere because of the internet. Well, AOL bought Time Warner. So that was a new internet company buying traditional media, Time Magazine and Warner Media. So that's movies and TV shows and print media like I believe Time and Sports Illustrated. And in those days, magazines were still paper printed magazines were still a thing back then. Wow, right? And I was looking forward to becoming an illustrator for those magazines too. Even Mad Magazine, I even thought of trying out for. I sold out. And it looks like it only bought me an extra 5 years of running into adulthood because I was like, oh no, I have run out of runway. And so AOL bought Time Warner. New media buys old media. And I was sitting there going, this strategy doesn't make sense. New media should be buying new media and consolidating. Why did they buy old media? And it dawned upon me that maybe the writing was already on the wall for new media. They were looking for figuring out how to get traditional revenue from traditional advertisers and traditional subscribers to pay for this newfangled service. Yeah. So the scramble for revenue from any source other than wild speculation on Wall Street had begun. And I thought, okay, shareholders are going to look for real numbers, real money, real customers, and not just hype of click-through rates of web traffic. And that's when I sold my options. I sold my options just after the peak of the market. I can't say I timed it right on the top because I'm not that smart. But as soon as the Time Warner AOL thing came on, I went, oh, geez. The metrics have changed. That's what they call it then. I wasn't that savvy. I said, oh, this doesn't look like the model that my own software company's pitching. And it was and that deal was totally lauded on Wall Street. Wall Street fell in love with that deal. So all of a sudden, newfangled internet companies are trying to buy old assets, old media assets and stuff. And I went, uh-oh, this is not what my company is doing. So even if it's only a company-only story, it's not a good story. Well, it turned out a lot of other companies shared my company's not so good story. Okay, let's keep going.
Some have lost up to half their value already.
There could well be some very good buying out there. I think people who panic will be probably be making those bargains available to the canny investor.
And spare a thought for Bill Gates. The Wall Street collapse cost the world's richest man a mere $1.8 billion this week alone. Eddie Meyer, 10 News.
Yeah. So, yeah, Bill Gates. Yeah. Yeah. Who's still around? Yeah. So, but look at that. He managed to survive with his billions in spite of all this volatility. So, what does it take to be a survivor in this kind of environment, right? I can't say that I made out like Bill Gates or any other tech giants or Mark Zuckerberg or anything like that, but there. Let's just say this: the reason why I titled this stream "Wealth and Wellness" is that wellness is also something that I factored increasingly into my investment strategy, and now that things have gotten rather too exciting lately in the markets, I can still sleep at night. May not be making as much money as I'd like, but I can still sleep. And I'll let you in on it once we see a couple of more videos, and then we'll talk about how I keep my physical and mental wellness throughout all of this stuff. Here, I'll give you a hint. This is the dumbest hint, but here's a hint. I'm just going to turn off the video for a second. I just go to look at pretty flowers. This is a photo from today. This is from the very same square I took pictures of the outdoor DJs and the sakura blossoms at the train station downtown. Yeah, look at those. Aren't those pretty? A pretty spring day, finally, warm, 18 degrees Celsius, about like 65 Fahrenheit. Very nice, very comfortable, beautiful. And I guarantee that anyone who was out there today was definitely not thinking about the markets. And that's one hint. Okay. Okay, let's go on to the next video here. So remember that fellow with the glasses just a moment ago spoke and said, well, maybe a canny investors who will buy the stock that people panic with. Well, we got a bit of a tutorial on that.
Hey there. So you want to invest and get rich. Great. But now your portfolio is red, minus.
So I'm just going to back this up for a second here. Okay. Does that screen look familiar? Here we go. Oh, here we go. Oh my God. Okay.
Hey there.
Hey there.
So you want to invest and get rich. Great. But now your portfolio is red.
There we go. I've been seeing screens like this all week. look at, a normal market average is like, well, you have some going up, some going down. So you have some green squares, you have some red squares. If it's a big loss, it's a big red square. If it's a big rise, a big green square. And yeah, you're not imagining things. That's a pretty bad sell-off. And this video came from let's see his name, Explains 101. And he did this video was from, let's see here, just 6 days ago. like literally the weekend before all the crappiness started showing up. So this video is very well timed. I have to give him credit for that. But anyway, how to survive getting through this mess. Remember, I I watched my company just dissolve before my very eyes. Um, I think about 3 months after I sold my stock options, I got laid off from my company, the micro, the software company that I was working at. So I became a dot bomb victim, and then for 2 years I struggled because guess how many multimedia graphic artists who weren't software engineers were suddenly dumped into the market. And there was this thing called the internet. So all of a sudden, these companies could realize that they could hire freelance artists from places like Philippines and Hong Kong for like 80 to 90% cheaper than what I could charge. I would literally have to, in order to compete with those prices, I'd literally have to charge minimum wage in order to get those jobs, and I wasn't about to. I found another way to find work. I'll talk about it after this video, but let's just say it involved a lot of self-employment, and that's the other survival strategy: is self-employment. It's not secure, but it did teach me a heck of a lot, and it did land me into a better career path that I credit to this day. All right, well, let's go watch this video. So it's a sea of red out in the stock market. What do we do? It's also coming in a little loud, so I'm just going to turn it down just a ditch. Just a little bit. Here we go.
Minus, minus. Every time you check, it's worse. The news screams about crashes, recessions, and corrections. But what does it all mean? Should you panic?
Yes.
Buy more? Sell everything? Or just close the app and cry? Before making any moves, remember that many market crashes in history have created new millionaires. This might be your chance to become rich.
Yeah. Yes, many fortunes have been made during crashes because there's a saying on Wall Street that says they keep your powder dry. In other words, keep some cash on the side, and if a good bargain happens to sort of pop up, something that's mispriced to the downside, you might want to snap that up. Like it's what Howard Marks calls Howard Marks is one of the most canny, smartest credit fund managers ever, and his memos on Oak Tree Capital are very memorable and very smart. And he said that sometimes just think of it as a sale at Bloomingdale's, your department store, and everything's marked down. And he said that even this week with the stock market crash, the Bloomingdale's beside Bloomberg Studios, where he was being interviewed, he was seeing for sale signs all of a sudden sprouting up in their windows because they know, traders aren't going to looking to buy some new ties this week, but maybe we'll be able to persuade them to come in and buy something at least. Maybe they want some cheap retail therapy, and so we can at least keep the lights on in this place. So things do change, sentiment does change, business behavior does change, but you just got to roll with it. All right. And one of the ways is to have a cushion of cash, right? This is one of my this is what by accident happened to me. I had a cushion. Here we go. Let's keep going.
What? Really? Then how do you do it? Before we start, let's first understand, why do stock markets crash? Is this normal, or should you be worried? How do you survive a crash? And most importantly, how do some profit while others lose everything? In this video, we'll cover everything you need to know about stock market crashes. Let's get started. Section 1. Why do stock markets crash? To understand stock market crashes, we first need to know why they happen. A crash is when the stock market suddenly drops fast, meaning
Okay, so again, I want to speak on this. So a stock market crash is different than a correction. A correction is usually maybe a 1-day event or a 2-day event, and it may only apply to a sector. Say maybe if there's an too much oil on the market and energy companies fall down for 10%, but the rest of the market could be just humming along just fine. Like, whoop-de-doo, cheaper oil. As an airline, that's great news for me, and my stock will go up, right? So this is like a typical winners and losers kind of market. Crash is like, well, everyone's a loser, baby. There's no winners, right? So that's a whole different kettle of fish, right? And so what we went through this week is probably going to be defined as a crash. Now, is it right now? It's a little bit past correction. Some stock indices have already entered into bear territory. Bear territory is usually defined as a 20% drop from the all-time high. So, for example, Bitcoin would be considered, even now with its gyrations going a little bit up this week, is still down almost 20% from its all-time high. So it's still in bear market. So, but they have something called bear market bounces, where something could just be in a bear market but still rally up for a short spell and then go back down again. These are the things that just drive me nuts, frankly, and I've always know that I have a keen sense of choosing the wrong turn. I'll explain. I'll explain one of my big winners and big losers on that. Not big, actually. Let's just say the amount of energy and effort I put into it. Yeah, I didn't get a firecracker. All I got was a little cherry bomb, a little squib out of it. So thankfully, the trade did not blow up in my face, and it's not something that requires a lot of finesse, unfortunately. Maybe I should have finessed it. But anyway, here we go. Let's keep talking about crashes.
many stocks fall sharply. This usually happens for 3 reasons: bubble bursts, bad economy, and black swan events. Let's break them down. The first is bubble bursts. You've probably heard the word bubble thrown around in the stock market. But what does it actually mean? A bubble happens when stock prices go way higher than they should.
Yeah. So again, this is different than a correction, because a correction is just like the markets realize they've overpaid for something and they pull back. Whereas this is like a sudden surprise, and it catches more people by surprise. In fact, it usually catches the consensus, and that's why there's some traders that call themselves contrarians, who do not go by the consensus, the groupthink, the herd mentality of this of investing, and go, no, I'm going to take the other side. I'm going to be the guy on the other side. Um, so there's contrarian investors, right? Classic contrarian investors are funds that take on shorts. That means they're betting against a stock or a commodity or whatever, and they're just waiting for it to fall. Through some financial engineering, that fall helps them make money. So, that's, hey, whoa, there's great videos on shorting. I'm not going to explain it because I've never done it. I'm not about to tell you stuff that I've never done. So, this is my lived experience in the investing world. And again, don't take any advice from a cartoon half goat man on the internet, okay? Please don't. For the love of God. All right, so let's continue on.
Usually because of hype, not real business growth. And when investors realize this, they all sell the stocks, and the stock's prices drop hard. A real-world example is the dot-com bubble in the early 2000s. The internet was the new hype.
Yeah, so this is like the outside explainer explaining my inside world of working for a dot-com company, precisely that basically describes my company, right? It just got way overhyped, We didn't even have a finished product, believe it or not. We were always still in development. We had teams of software engineers building something in development that never seemed to get to a finish line. I was actually screaming at the whole time, going, we actually have to produce something, guys. Like I've made these wonderful graphic user interfaces, or what they call GUIs. Now they call them user experiences. Don't you love technical jargon? Anyway, so I was making GUIs with my JPEGs and my GIFs. I was a real good GIF animator. Yeah, I was pretty good. I have to say, I managed to make them all very, very, very small data files. I just maximized the crap out of them, so they would just be downloaded fast. 'Cause remember, those were days when there was internet was dial-up. Dial-up internet. Can you believe it? Anyway, let's keep going.
And investors threw money at any company with .com in its name,
Like
even
mine.
if it had no profits and no real business model.
Yeah.
At its peak, over 400 internet companies went public. And the NASDAQ, the tech-heavy index prices, jumped by over 800% in total.
So imagine that. That's like a meme coin, right? So the .coms were like meme coins, or yeah, right? Meme coins or meme stocks or whatever. They were flying high, including the company. My company was not traded on the Nasdaq. It was traded on a more regional board, stock trading board. But so be it. It went from a few dollars to $100. So some of my engineers who had bought in stock options way early. I actually, by the time I showed up in the company, they were already like in their second or third funding round. So I only got the tail end of that spike, but the early engineers who were working from the start got really loaded because they bought stock for like, I don't know, at that point, like half a month's salary for $2,000. And all of a sudden they were walking away with like $250,000. Holy moly. I missed that ride. Oh well. What do I know? I'm a cartoonist. I'm no engineer. Anyway, you can see some of the failed companies during the bubble. Pets.com, the unfortunate poster child of the whole .com era, right? Because pets can't drive. In other words, it'll just be delivered to your door, right? Webvan, eToys. I forget what Boo.com did. I don't remember that. But definitely Amazon. Think about that. eBay, Cisco. Cisco was really highly priced. So was Northern Telecom for you Canadians out there. And need I say anything more about BlackBerry? If you Canadians from Waterloo, remember BlackBerry. And BlackBerry was my hero for a while because they couldn't stop talking about it on CNBC. I remember then CNBC anchor Maria Bartiromo just loving the heck out of her BlackBerry. And she liked the clickety clack of the buttons to print out texts and emails to. She just loved it, her BlackBerry. And yeah. Anyway, that's we'll talk about. We'll reminisce about that sometime. Great movie on BlackBerry came out last year, and it definitely I relived my corporate life at that time through that movie. It was quite a time machine for me because a lot of the things that they were talking about and the corporate culture sure as heck reminded me of what was going on back then. Anyway, keep going.
But when people realized most of these companies were not making money, the investors sell all their stocks and the bubble popped. The NASDAQ, a tech-heavy stock index, crashed nearly 80%, wiping out trillions of dollars in market value, and needed 15 years to return to its original price before the bubble.
Yeah, so sorry, I said 10, it was probably closer to 15. Sorry, I misspoke. That's why you shouldn't listen to a half goat cartoon on the internet about financial advice. But the charts don't lie. You can see that it took 15 years for it to return back to its original all-time high. Since then, it's gone up quite a few, but 15 years of dead money, right? It's like I said, it's the equivalent of stuffing money into your mattress and just digging it up 15 years later. You wouldn't get the same amount. But of course, inflation and cost of living would have gone up. So you actually still would have backslid quite a bit. All right, let's keep going.
That's how bubbles work. Hype inflates prices, reality pops them. Then the second reason is a bad economy and certain policies. Bad economic condition, like when inflation is too high, makes food and rent more expensive. People cut back on spending, which means businesses make fewer sales.
So have we had an inflation spike lately? Sure as heck did. So that's going to affect GDP. And what's been really odd is that we've had two false false dawns of 2 or 3 false dawns of recessions. Recession signals would get really strong. There's something called the inverted yield curve. I'm not going to go into it here, but let's just say that the bond in the yield on bonds, instead of getting higher with commensurate risk into longer dated bonds, that means more into the future, the more you should pay in interest, because you can't predict the future. Seems fair, right? But an inverted yield curve means that the further you go out into the future, the lower the price of the bonds get, which is inverted. And that's usually a sign of a recession coming, because that means that they're perceiving that economic activity is going to go down in 2, 5, or 10 years, or whatever the yield curve out that far does. Because remember, central banks like the Bank of Canada here, or the Federal Reserve, or the Bank of Japan, they only really control overnight rates. And this weekend, I've seen that I think it's the Swiss National Bank, the SNB, has overnight negative interest rates, which is basically like the post Eurozone crisis time, the post Greek debt crisis time. Yeah, and around I think 2010, wasn't it? Anyway, yeah. So we're revisiting some financial oddities yet again in the wake of this week.
When a company earns less, investors expect lower profits in the future. So they sell the stock and the price goes down. If this continues, it can lead to a recession when the entire economy shrinks. Production slows down, spending drops, and investors panic, causing the stock market to fall even further. That's why recessions are often linked to stock market crashes.
So it creates and you can see that if the profits go down, and then people see the uncle Jeb gets laid off from the shoemaking factory, and they get scared, so they spend even less, and it becomes a vicious cycle downwards of less and less spending, and meaning less profits, which means less spending, which means less profits, which means less spending, and so on, right?
Sometimes certain policies can also cause crashes. When the inflation rate is too high, the central bank raises interest rates to slow down the inflation, making loans more expensive. Businesses that need money are struggling, so they cut production. People start saving money and spend less, which spreads panic and pushes stocks down even more.
There's also another incentive for people to cut spending when interest rates go up to fight inflation, and that is to park their money in the bank and earn interest, right? So if I can get, like, let's say if my checking account all of a sudden has a 7% interest, and the stock market is only giving me it's like a post-crash level of maybe 1 or 2%, where do you think I'm going to park my money? Checking account or stock market? Seems a pretty easy answer, right? People cut spending because they'll park it in the bank or some instrument of credit that has a yield better than the stock market, right? Anyway, here we go.
And that's why every time this guy announces interest rate changes, investors are worried.
So if you guys don't know who Chairman Federal Reserve Chairman Jerome Powell is, there you go. That's him. That's who you saw there. Other luminaries are Alan Greenspan and Paul Volcker. Each one have their own regimes and own styles. They're very distinct. There's not someone who's like Ben Bernanke, for example. The Fed chairmen, their styles definitely put a stamp on monetary policy. So definitely figure out what their playbook is if you want to sort of figure out what changes could be happening. And the same goes to for any central banker in your jurisdiction. Just pay attention to the personality, the resumes, and what they've done in the past, and figure out what potentially they could be up to. It's always harder, of course, when you have a new central bank chair or a leader, and they don't have a track record. For example, Kishida of the Bank of Japan, relatively new. He's got about a year or so in. There is some ideas of what he's up to, but again, he's more of an unknown quality.
If rates go up, loans get more expensive for businesses, and stocks usually drop. If rates are cut, loans get cheaper, businesses have more money, and stocks usually rise.
Also, gives opportunities for businesses to refinance at a lower rate, and so so even if they have more punishing interest rates or credit terms, they can in a lowering rate environment they can refinance at a lower rate, or maybe extend the length of their borrowing in duration and time, and sort of allow them to kick the can down the road. Sort of the same way that the central banks and or your local governments can do that too. Whoops. Not going to get into politics today, but it is a factor.
The third is black swan events.
So black swan events, those are sometimes natural occurrences, sometimes man-made occurrences, but it's definitely things that aren't, well, I'll let them define it.
Black swan is just another name of unexpected disasters, like wars, pandemics, terrorist attacks, financial scandals, and more. These kinds of shocks make people worry about the economy, which makes people get scared and sell their stocks as fast as possible, causing prices to crash. A real example is the 2020 COVID-19 crash. Nobody saw the pandemic coming, and within weeks, global markets fell by over 30% because investors panicked about businesses shutting down and the world economy collapsing.
Sorry, I paused too early. So yes, COVID-19 is a perfect example of black swan. It was not something that any central bank could have foreseen in their modeling, even a quarterly modeling. It was such a unique event that probably had not been seen for 100 years, that there was no real playbook, right? And the one thing that markets certainly don't like is uncertainty, as in, when's this pandemic going to end? Shrug, right? Nobody knew. And again, what about this current this current crisis in the stock market? When's it going to end? Shrug, don't know.
So these three are the main reasons behind a stock market crash. Of course, there are other factors too, like too much leverage, margin calls, or even herd behavior. But we won't go deep into those, since I want to keep this video simple. Now, we know why stock markets crash. But the real question is this normal, or should you be worried? Let's find out in the next section.
So, comment down below if you think this is normal or it's not normal for it to happen. I have my own opinion. I'll reveal it at the end, but there we go.
Section 2. Are stock market crashes normal? Yes, stock market crashes are normal. The stock market doesn't just go up all the time, it moves in cycles with ups and downs. If you're investing for the long term, you need to understand that crashes are part of the game. In fact, for traders, these ups and downs are opportunities for them to buy low and sell high.
Yeah. So, for again, uh, the market is volatile. There's people willing to uh, play in whatever sort of time frame that they want to play in terms of getting a return, right? There's day traders who try and make money within a day. There are people who are swing traders who might take upwards to 2 weeks to a month for a trade to play out, and everything in between, and long-term long-term investors like the Warren Buffetts who stay in companies for multi-year spans, right? So it depends on what you feel comfortable in trading in. Um, Obviously, what I'm going to tell you right now is that I've never been a day trader. Um, I'll tell you a funny story when I tried to be a physical day trader. So I was working. This is in my post software career. Uh, I discovered I could be self-employed teaching art to children after school. There you go. I got self-employed. The problem was that was only about 2 to 3 hours of work a day. So, so I got paid handsomely for the time for doing it, but it was still extremely part-time work, and I was still basically eking out a minimum wage income, even though I was being highly paid for 3 hours, but stretched out over weeks and weeks. It was, just enough to get by, and I was slowly sinking in debt because I was also supporting my girlfriend. Don't forget. So that was a burden as well, and I took on that burden because I was in love and I felt responsible. So anyway, so I was going slowly into debt, and this was driving me a bit nuts. So I ended up getting a job with the with a more permanent job, working with the children at nonprofits and such. But one day at one of these uh, community centers I was working at, it happens to be neighbors to a coin and bullion shop, uh, precious metals, and Brexit was happening. So the Brexit referendum was happening, and I realized just from listening to the radio and going, "Hold it, this sounds like Brexit might actually happen," which is not what the market priced in at all. It's not what the betting market was kind of hinting at, but it was actually becoming actualized. And I ran out of my job. I said, "Sorry, quick coffee break." I ran out to the job, and I tried to get to the doors of the gold shop because they closed at 5:30, and it was 5:25 when I realized something was happening. I ran over, and they had just locked the doors, and I ran across the street waiting for the light. And I missed gold's $200 move in that hour. In that hour, gold moved up $200 Canadian, mind you, because I'm Canadian, in the spot in just 1 hour because of Brexit. And I was so mad. I was so mad. I'm going, I can't believe it. That was the only time I tried day trading. There was no software. There's no. You can see a pattern with my investment. There was no software. There was no electronic screens. It was just like I had a feeling like, oh no, this will cause gold to spike, and it did, and I missed it. So you can't time the market, guys. Even if it's literally just half a block away, can't time it because things will get in the way. Um, might be too much traffic flow to get a trade in. You never know. Things will happen. So, missed out on $200, man. But I got my revenge later. But we'll talk about that a little bit.
Because if stocks only went up, everyone would just invest long term instead of trading. Believe it or not, history shows that the market follows a repeated pattern of market downturns. The first is pullbacks, when stock prices fall around 5 to 10%. This happens almost every year and is considered normal market movement. The second is corrections, when stock prices drop 10 to 20%. As the name suggests, corrections happen when investors realize that the stock prices are overpriced and corrected back to their fair prices, usually every 1 to 2 years. The third is bear markets, when stock prices fall around 20 to 40%.
Yeah.
This usually happens every 5 to 6 years, often due to economic slowdowns or rising interest rates.
I cut you off too early every time. Sorry, dude. So just remember, this explains 101. If you want more content like this, just explains 101 is this channel. So yeah, and rising interest rates. So that's a 20 to 40% drop. Remains to be seen whether we're in one of those right now. Maybe.
Because the economy isn't always good like a fairy tale. And the last is crashes, when stock prices drop 40% or more. These happen about once every 10 to 20 years, usually due to black swan events like financial crises or global disasters. So this is the table of differences. Feel free to take a screenshot. History has proven again and again that the market bounces back and even gets stronger after every crash. In 1973, the oil embargo crash sent markets down by nearly 50%, and it took about 7 to 10 years to fully recover. During Black Monday in 1987, the New York Stock Exchange crashed 22% in one day, but recovered in 2 years. During the 2008 financial crisis, the S&P 500 crashed nearly 50%, but eventually recovered in 4 years. During the 2020 COVID-19 crash, the New York Stock Exchange dropped 30% in just 5 weeks, but fully recovered in 4 months.
So not all crashes are created equal. You can see that. Oil embargo crash took 7 to 10 years. Black Monday in 87 took 2 years. The Great Financial Crisis took 4 years. And COVID-19 recovered in 4 months. I think, and this is just my own personal opinion, so take it for what it's worth. Again, do not invest with my advice. Is how much the consumer is affected, right? So Black Monday crash, that really affected Wall Street types, but it didn't really affect Main Street. So the recovery was relatively short. The oil embargo and the Great Financial Crisis in 1973 and 2008, that affected more of Main Street as well as Wall Street, so regular people. So it took a bigger toll on the greater economy as a whole. COVID-19, it crashed relatively fast because of unprecedented loose money policies coming out from a lot of the industrialized world. So in that way, they were trying to cushion. You see what they're doing? They were cushioning Main Street there in 2020. So Main Street and how it's affected really, I think, affects the length of these crashes.
Different crashes, but the same pattern. Market falls and come back even stronger. So, who lost money? Those who panicked and sold. And who made money? Those who stayed calm and held strong stocks. But some people still panic and say historical performance doesn't guarantee future results. What if this time the crash is different and never recover? How do we know? That's not completely wrong, but there are indicators to help you know when a crash is just part of the cycle and when you should actually be worried. Crashes
Yeah.
are normal if you see the businesses are still operating. People still can spend and do leisure. And some actions have been made to stabilize things. Then the crashes most likely will recover. But this mainly applies to big, stable economies like the US. In smaller or unstable countries, crashes can take longer or recover differently. So you need to understand your country's condition.
Yeah. So, for example, the lost decade in Japan. How many retail investors, uh, i.e., the Mr. and Mrs. Tanakas of ordinary households, got affected by that. A lot of them did. And that's what I mean by if if the retail investor or Main Street investor gets clobbered in these crashes, along with Wall Street or their particular stock market, national stock markets themselves, get clobbered at the same time, then recovery might be slower. That's all I'm saying.
You should only start to worry if the entire economy breaks down. Like, if businesses keep failing, banks go bankrupt, people can't access their money, and the country defaulted on its debt. Those situations are extremely rare, but if they happen, then yeah, that's the kind of crash that's much harder to bounce back from.
Mm.
Now you understand which crashes are normal and which ones are not. So your next question is, how to survive during stock market crashes? Well, let's find out in the next section. Section 3. How to profit from a stock market crash. A stock market crash might seem like the worst time to invest. You might be wondering, how do you even survive it? But here's the surprising part. Many people actually make huge profits during a crash. For smart investors, a market crash is one of the best opportunities to build long-term wealth. Like Warren Buffett said, be greedy when others are fearful. So how do you actually do that? Let's go through some common mistakes and what you should do instead if you want to profit during a crash. The first mistake is panic selling.
Yeah, so I've committed this sin numerous times because I was a victim, like I said, of the 2000 dot-com bubble. So whenever I would gingerly dip my toe back into a mutual fund or something for my retirement fund, I'm not proud to say, um, from about 2000 till about actually this year, I would gingerly put some token money in to some tax shelter for retirement funds, whatever that tax shelter takes form in your jurisdiction. Look it up. I don't know it. I'm no expert, retirement expert. So, but I would gingerly put money in, and then as soon as there was like a market wobble, I'd pull it back out, and then I'd miss the rebound, and I would just say, no, I'm waiting it out anyway. I don't care. Things are going to go to crap again, and I'm just going to just wait till it goes back to crap. Well, it never went back to crap because by the time my fear had subsided, the market had already took off again. So yeah, I was a very emotional investor, not gonna lie, but I had every right to be. I was spooked. I mean, I lost to 2000. I lost my job. Then I had to be self-employed and struggle for years afterwards. And then in the midst of reinventing myself in this thing, I lost my girlfriend, and she was the most stable relationship I had to this day. And so, yeah, it broke my heart. This is what I meant by the wellness and wealth part of my talk, because what your personal wellness and the wellness of people around you is very important and should be actually factored into your financial decision making. What? Yeah, it should. There's intangibles, guys and girls. There's intangibles. And the stuff that is not, you can't find on an Excel spreadsheet. And that should be part of your financial decision making. Yes. All right. So no pie in the sky, no FOMO, no going to the moon. Just think how is this going to be a net benefit for myself and the people I care about? That that should be your North Star for investing. But to each their own. If you want to just listen to Wall Street Bets instead, go for it. Not going to yuck on someone else's yum. But that's if I want to sleep at night. Some people don't sleep at night because they missed out on this great trade, and I'm like, I've missed out on so many great trades, but there's some better strategies rather than trading, and I'll get to that in a second. All right, let's keep going.
When people see their portfolio turning red, their first instinct is to sell everything before it
That was
drops
me.
more.
Yeah.
But here's the truth. You haven't lost money unless you sell. A stock might be down, but it still has a chance to recover. But if you sell at a loss, that loss becomes real. If you invested in strong, profitable companies, there's usually no reason to sell just because the market is down. Instead of panic selling, stay calm, stay informed, and focus on the long term. The second mistake is trying to time the bottom.
Yeah.
Some investors try to predict the lowest point of a crash and wait for the perfect moment to buy. But the problem is, how accurate can you predict the lowest point?
Yeah.
Many people wait too long and miss the lowest point, while others buy too soon, thinking prices won't drop further, only to see them fall more. Instead of guessing, a better strategy is dollar cost averaging, or DCA.
Yeah, so they'll explain dollar cost averaging in a second. For those of you who are fundamental or not fancy investors like myself, I wouldn't know an options contract if it fell on my head, and I'm actually not interested in it. It might have been this video, might be another video, but they said Warren Buffett all said you have to understand what you're buying, right? If you don't understand it, then don't touch it, right? So dollar cost averaging, they'll explain it. I have a bit of a twist on DCA, dollar cost averaging. They'll explain once we get through this chapter.
DCA means investing a fixed amount regularly. So you buy more when prices are low and less when prices are high. This removes the stress of trying to time the market. And as long as you buy strong, profitable companies, DCA should be a worry-free approach, as long as you're confident in the company's long-term strength. The third mistake is buying bad stocks just because they're cheap. If you noticed, I keep emphasizing buying strong, good, and profitable companies. Why? When stock prices crash, it's tempting to buy anything that looks like a bargain.
Right.
But not all companies recover. Some businesses fail completely and their stocks never bounce back. That's why it's so important to focus on strong, profitable companies. Those with low debt, solid earnings, history of surviving tough times, and good prospects.
Yeah, and another way to measure low debt or solid earnings is if there's other telltale signs like have they never cut their dividend? A company that's in trouble may pay out dividends, but then they might claw back their dividends or even skip dividend payments, and that's a sign as well of not a good stable cash flow, right? So just think about what are the signs for you? What are the deal breakers for you to buy a stock? Yeah, and these are what they call screens. What screen did you run this through? It's basically a filter. What filter? What comes out to the other side through these filters, right? What else was I going to say? Oh yeah, so my form of dollar cost averaging, and it was recommended to me after we banged our heads together with my investment advisor, was that I was really worried about market volatility for this year, and I was looking to rejig my retirement portfolio. So what I did is I put it into a guaranteed interest certificate, a GIC here in Canada, and they're called CDs in the United States. Basically, you're guaranteed a certain amount of return, a certain percentage at any sort of given duration, be it 3 months, 6 months, a year, 2 years, 5 years. You're guaranteed a rate calculated annually. So what I did is that I bought one of those, more the short-term ones, but the interest that I get from that is going to be paid out monthly, and every month I'm buying into uh, a tech and innovation uh, ETF as well. So that means that I still am a strong believer in tech, but right now tech is pulled back, which means I can buy more of company X or company Y in tech, and these are top performing tech companies like your Microsofts of the world and Google's. And what's going to happen is that even if they pulled back, I just happen to own more of those shares. And then hopefully those shares will bounce back in 10 or 15 years, which is fine because it's about the time I retire. And my money is still, I'm only really skimming the interest off my GIC, my CD, my guaranteed interest rate. And that means my money stays flat. Now, inflation might get me, but I'm hoping that the gains from my investments will outstrip inflation and the actual interest rate of my GIC, at least for the medium term, which is about 1 to 5 years. Okay. And if it doesn't, well, I didn't lose money. That's that's the crux. I'm not sitting on a huge nest egg, but I just figure if I'm not losing money, then even when I come out the other side and I haven't lost money, I might not have gone gangbusters, but then also my net debt is pretty much close to zero every month. So being debt free, even in a low debt environment, is still a bonus because I have a feeling that even if we have a lower debt, in fact, as I've already seen negative interest rates out there recorded right now as we speak, how many banks are going to take out risky loans for you, though? So it still might be, the numbers might be low, but how loose or tight the credit is going to be given out by the banks. I suspect with a whole bunch of uncertainty, you can drop it down to zero, but the banks may not be lending because they're still afraid to get their fingers wrapped. So we'll actually see how much credit gets looser. It might just go down to zero, but how much is actually freed up to lend? That's the $60 trillion question. All right, keep going.
During a crash, great companies become cheap not because they're bad, but because everyone's panicking. For example, before the 2008 financial crisis, Amazon stock was at around $90 per share. If you had $1,000, you could only buy 11 shares. When the crash happened, Amazon dropped below $40 per share. Now, with that same $1,000, you could have bought 25 shares instead. If you had done your research and believed Amazon was a strong, profitable company with good future prospects, you could have bought it at that price. A few years later, Amazon rebounded and skyrocketed, reaching over $3,000 per share by 2021. That's over 8,000% growth. That means those 25 shares from the crash would have been worth over $75,000. And if you're interested in investing, Moomoo is a good platform.
And here comes
to try.
the ad. Okay, I gotta
Click
move
the link
ahead.
below
No
to get
ads,
up to
no
50
ads. There we
investors
go.
put all their money into one stock or sector, thinking it's a sure bet. But when a crash happens, some industries fall harder than others. Smart investors spread their investments across different sectors like tech, healthcare, consumer goods, and utilities, so that if one area crashes, others can help balance the losses.
Remember what I said. If oil crashes, then it might benefit airlines because all of a sudden their fuel costs go down. So if your energy stocks crash, maybe that means your airline stocks will take off. So there's always going to, so you have to think also of a winner and losers kind of play with individual stocks and sectors, and you may even go beyond stocks, right? I wonder if they mentioned it here. I can't remember.
Some even diversify
Yeah,
into
non-stock
non-stocks like bonds, commodities, or international stocks to protect against stock market crashes.
Yeah, so non-stock alternatives. So commodities. You notice that there's oil and wheat, but no one's going to take on a million bushels of wheat. But you can certainly buy some gold. I bought gold. I won't tell you when, but because I can't time the market, but I bought it in Canadian dollars about $2,500 ago. That's how I measure time in gold. $2,500 ago. Right now, gold in Canadian dollars is $4,300 an ounce, and I bought mine at around just a hair above $1,700, $1,700 an ounce, and now it's 43. So that's about 25, 26 $100. So almost to 3x, not quite, maybe 2.5x return. Not bad. And because I don't sleep at night, I do sleep at night because at the time I made a rule. Anything crazy that I wasn't sure of, I made sure that that was only 1 to 5% of my net worth. So if you go to the horse race at the racetrack and you had $500, you bet on all the horses for the whole day, and you came home with $450, losing $50 on it, you'll still say, it wasn't a great day at the track, but I can still sleep. It's not like I'm gonna be sleeping on the couch with Mrs. Datchy really mad at me, going, well, how'd you lose $500 at the racetrack? You're irresponsible with your money. If I just say, oh no, honey, I had a so-so day at the racetrack, I only lost $50. Out on the track all day, $50. Will that make you lose sleep? Not really. Might get you side eye from your partner, but it was definitely would not affect your relationships and that sort of thing. So if you are willing to spend, say, 5% on something that seems a little bit beyond your comfort zone, or a little outre, like a little gold or a little Bitcoin or whatever, 1 to 5%, can you afford to lose 1% of your portfolio? I think you can, considering that the upside is still going to be upside, right? So, yeah, this is how I've been able to sleep at night, because I know that even though I'm not all in, I'm also not all in for the bumps and grinds either, right? So look for alternatives, even that are nothing with stocks or bonds. That was my side bet was gold, because at the time, oh yeah, one other mistake is that I only bought always buy things in multiple units, because they're easy to sell in pieces that way. So don't just buy one share. I mean, no, you can sell fractional shares these days, but I have a feeling that there's actual wipeout at any sort of stock exchange. Who's going to buy 1/17th of a Nike share, right? No, they're going to be selling whole shares, and the 1/17th may not even get a bid, right? You might be left holding the bag on that one. So just be aware of that. Keep going.
If picking individual stocks sounds hard, then you can consider buying funds like ETFs or index funds, which make it easier by automatically spreading your investment across multiple stocks. This way, you don't have to pick individual companies yourself. If you want to understand more about funds, check out my other video about ETFs, mutual funds, and index funds. Link in the description. The last mistake is FOMO, or fear of missing out. When panic spreads, people blindly follow what others are doing. If everyone is selling, they sell. If the news is predicting doom, they believe it. But even legendary investors like Benjamin Graham and Peter Lynch have said that even Wall Street professionals cannot predict the market perfectly. So make sure you understand what you're buying by doing your own research. And if you're still unsure, it's totally okay to speak to a financial advisor. But either way, you should always understand what you're investing in. Never blindly follow anyone, not even the pros. Like Warren Buffett says, never invest in something you don't understand.
For sure.
Now, those are the common mistakes and smart actions for beginners. But there's one more strategy that some professionals use to profit from a crash, which is called short selling. It's when you bet that a stock's price will drop. For example, imagine your friend owns a stock worth $100. You borrow it, sell it for $100, and wait. If the price drops to $70, you buy it back, return it to your friend, and keep the $30 difference. But if the stock rises instead, say to $120, you'd have to buy it back at a loss. Some legendary investors made billions shorting the market, but it's extremely risky. That said, I'm only explaining it for knowledge. I don't recommend it, especially if you don't fully understand how it works.
Yes, because if you don't know at what level the stock is going to top out, you could theoretically be up down hundreds of dollars, right? Because they don't just sell one stock; they usually sell them in lots of 100, for example. So you might be down $20. That's $20 times 100 stocks, which is $2,000. You'd be down 2,000. So don't. It's tricky. There are what's called inverse funds that actually take the reciprocal. That means they actually do the flip side of like if you say there's the SPY, which is the ETF mimicking the S&P 500. There's also funds available that give you the shorts or the inverse of SPY, and I haven't checked them this week because I'm not a short seller guy, but I'm sure that they did gangbusters this week, right? The ones that are inverse SPY or other sectors like tech, right? Yeah, but that's not in my personal experience, so I'm not going to recommend it just because tonight I'm talking about investment from my own personal experience, so I'm not going to even talk about it. I'm not even going to plant the seed of an idea in your head. I'm not even sponsored by a financial anything. I'm just speaking from my own experience today, okay?
So, in conclusion, a stock market crash feels scary, but it's just part of the cycle. Historically, the U.S. stock market has always recovered and even reached new highs after crashes. While no one can predict the future, past patterns show signs that recovery is likely unless the economy completely collapses. The key to surviving and profiting from a crash is staying calm, avoiding panic selling, doing thorough research, and buying quality stocks at a discount. Panic sellers lose, but smart investors turn crashes into their biggest wins. So, when the next crash happens, don't fear it, but be ready.
And be ready, and that's why I'm sitting on my cushion of cash and seeing what bargains come to the surface, and I might scoop up a few, but I'm not sure. And don't know. It's way too much uncertainty right now. One measurement of fear and greed is called the VIX, which studies the price of options. And of course, the higher the option price means that there's higher VIX, which means there's higher volatility in the market in that day. The VIX closed on its highs on Thursday, on the announcement day, at 30. And then Friday, it closed at $45 at the highs of the day as well. So it ends on a day on a high. You don't want to see that. That means most of the time institutional investors usually like to trade in the last hour of the day, and if they're pushing the VIX higher because they have to cover their butts a lot more, and it's getting more and more expensive to cover their butts as insurance gets more dear, as it gets more coveted. um, that's not a good trend. The trend ain't your friend there. So 2 days where the VIX ended ended the day on a higher high or close to its all-time high of the day. And of course, the following day things go really ratty. So hopefully, I don't know, maybe there's a breather this weekend, maybe 48 hours for the market to stop hyperventilating and come out of it next week. But I have no idea. And it ended at an all-time high with the VIX, and I have no idea. Again, I'm just a half goat, half cartoon guy. Don't take my word for it solely for investment advice. Seek other help. If you want help from another cartoon capitalist, check out Doomberg, Doomberg. He's the original cartoon capital markets guy. Hey, I'm not a pure capitalist. It's complicated. My relationship with money and wealth is complicated. It's nothing to do with trying to do some flex or some exercise some clout. It's just for comfort, really. Just be debt free and live a comfortable lifestyle. That's my main goal. And if you want to enjoy that yourself, let me just show you once again the intangibles, the intangible wealth out there. Let's see it again. There you go. Look at that. Oh my goodness. And also the reason why I chose cherry blossoms on my talk today is not because they're pretty, but they're a cycle too, right? They become bare leaves and then bare branches as the year trundles on. And then in the winter, they start to turn to little buds. And by springtime, this beautiful, beautiful, beautiful arrangement of flowers, right? And so humanity goes through its cycles as well. And so in whatever walk of life, be it even the markets have cycles. So that's why, hence, I chose cherry blossoms today. And so, spoiler alert, the most beautiful thing I've seen today was ta-da! You'll see it in my YouTube shorts as well. A couple of very beautiful things I saw. I saw people partying it up to an outdoor dance disco beside a sunken plaza full of flowering trees, including sakura like this. So beautiful. So this is the most beautiful thing I've seen all day. And who knows? If I feel a bit energetic later on, I might do just a quick stream of a game later. But I just wanted to tell you, thank you for listening to my rant slash history of surviving the stock markets and stuff. And I hope you guys well in your journey in wealth and wellness. Remember, you can't have one without the other, and vice versa. So please think of your wellness and the wellness of people around you when dealing with your wealth. Okay. Anyway, so this is Yaki Dachi saying, if you look hard enough, you'll find something beautiful every day, like sakura. So, might see you a little bit with a short little gaming session. But for the rest of you, peace out. Stay well, everyone. Love you, minasan. Take care.